Buena. Meet Karabo, a sharp matriculant from Polokwane, dreaming big about becoming a farmer one day. But right now, she's in deep trouble. The final exams are just 10 days away, and this production factor's topic in agricultural sciences, it's got her spinning like a tractor wheel in mud. Land, labor, capital, management. How do they all fit together? Karabo's heart is pounding. She needs help fast. Karabo slams her book shut, grabs her backpack, and rushes out the door. It is 2 p.m., and Karabo is running through the township streets, dodging kids playing soccer and vendors selling amagüeña. She arrives at the school gate, out of breath. The camera pans to the staff room window, where we hear muffled laughter and excited voices.
I have to find Mrs. Thando. She's the only one who can save me from failing this.
Inside the staff room, Mrs. Thando, a kind but no-nonsense agricultural sciences teacher in her 40s, wearing a colorful doke and a smart blouse, is chatting animatedly with Mr. Jacob, the stern principal with a mustache and a tie that's always a bit crooked. They're sipping tea, newspapers scattered on the table. The vibe is like a juicy gossip session in a soapy, dramatic pauses and exaggerated expressions.
Eesh. Mr. Jacob, can you believe it? South Africa hosting the G20 summit this year. All those world leaders coming to Joburg. But wait, there will be drama. President Donald Trump from America is throwing a tantrum. He says he won't attend because of some trade beef with our policies on agriculture exports, or maybe he started with those stories about the killing of white people in South Africa. Highball. Imagine the whole world watching, and he's like, nah, I'm staying home with my burgers. What if it messes up our farmers' deals? Our maize and sugarcane exports could take a hit.
Yo, Mary, it's pure soapy material. Trump tweeting fire, our President Ramaphosa trying to play peacemaker. But seriously, for education's sake, this is gold for teaching real-world stuff. Our kids need to know how global politics affects local production, like how labor shortages from international tensions could cripple our farms. If Trump skips, investors might pull out, and boom, no capital for new tractors.
True. And the management headaches? Principals like you would be stressing over school budgets if aid gets cut. But eesh, imagine the memes. Trump versus the Bray Masters.
Suddenly, the door bursts open. Karabo rushes in, eyes wide with panic. Her notes clutched like a lifeline. The laughter stops abruptly. Mrs. Thando and Mr. Jacob exchange a quick glance, straightening up like they've been caught in a plot twist.
Mrs. Thando. Mr. Jacob. Please, I need help. This production factors chapter is killing me. The exam is in 10 days, and I don't get it at all. Labor, land, it's all jumbled.
Karabo, my girl, calm down. Come sit. We were just, discussing current events. But you're more important right now. Tell us what's confusing you.
Yes, let's tackle this. Production factors are the building blocks of any farm or business. Think of them as the ingredients in your grandma's pap recipe. Without one, the whole thing falls apart.
Exactly. Let's start with labor, since that's often the trickiest. Labor is the human effort, the people who do the work. On a farm, it's the workers planting seeds, harvesting crops, or even driving tractors. Without skilled labor, nothing gets done. Remember that G20 chat we were having? Global events like that can affect labor availability. If trade deals go south, farms might lose workers to migration or strikes.
Good question. Labor works hand in hand with land, the natural resources like soil and water, capital, tools and money, and management, the brains planning it all.
Wait, like how? And how does it tie into the other factors?
For example, Trump's drama led to tariffs. Our farmers now need more local labor to boost production. But if wages are low, workers protest, then boom, production halts.
Karabo, do you know Agriscience's Matriculant's YouTube channel?
No.
Mr. Principal, Karabo is panicking, and I think it's better to help her now by unpacking the topic of production factors step by step.
All right, let's watch the Agriscience's Matriculant's Grade 12 Agricultural Sciences videos. Mrs. Thando and I will elaborate further on the points that George doesn't explain in detail.
Capital refers to the assets or finances that are required in the production process to make an income. Capital refers to the assets or the finances that are required in the production process to make an income. B. Assets. What are the assets? Assets are physical items that have a financial value or economic value. Again, items that have economic value or financial value and can be converted into cash. For example, building. Again, a building can be converted into cash. Machinery. Again, you can sell that machinery. Vehicles. These are the assets. Building, machine, vehicles, these are the assets. Physical items that have economic value or financial value that can be converted into cash flow. Cash flow. The money that comes into the business and out of the business over a particular time period. The money that comes into our business and it goes over our business over a particular period of time or a particular time period. Particular or specific. D, a budget. A budget is a financial plan that shows the predicted income and expenditure for a specific period. It is a budget. It's a financial plan that shows the predicted income and expenditure for a specific period. We have types of capital. Types of capital: A, we have fixed capital. B, we have movable capital. C, we have working capital, or we can say floating capital or production capital. We can choose from there. So, A, fixed capital is invested in long-term assets. These are fixed structures. Okay, these are fixed structures. For example, land or buildings. B, movable capital. Movable capital invested in medium-term assets. For example, we have vehicles, livestock. These are movable assets. C, working capital or floating capital or production capital. Working capital. So it's invested in short-term assets and is available to run daily operations. For example, seeds, feed, or fuel. We have methods of creating a capital. Methods of creating a capital. So capital can be created through savings. That's A. B, can be created using grants. C, can be created using loans. Savings, grants, loans. Types of credit or types of sources of financial capital. Types of credit or types of sources of capital or financial capital. Let's read this thing again. Types of credit or types of sources of finance capital. Captured, ne? Sharp. A. Short-term credit. This is when commercial banks provide funding for 0 to 2 years for working capital. For example, this can be fuel.
Yes, Karabo.
B. We have
George, I
medium-term
remember now. It is a
medium-term
credit that is
So
repaid
this is
over a
when
short period of time.
agricultural cooperatives
It is used for
provide
goods like
funding
feed,
for 2
fuel,
to 10
and
years
seeds within
for
one
buying
production
movable
season.
capital. For example, livestock.
Yes,
C.
an example for this type
Long-term
of
credit.
credit is
This is
livestock and
when
tractors.
land banks, that is when land banks provide funding for 10 to 35 years for buying non-movable capital, for example, land. So let's wrap up. Types of credit or types of sources of finance capital. A. Short-term credit. Commercial banks provide funding for 0 to 2 years for working capital. B. Medium-term credit. Agricultural cooperatives provide funding for 2 to 10 years for buying movable capital. For example, livestock. C. Long-term credit. Land banks provide funding for 10 to 35 years for buying non-movable capital, for example, land. This is where learners learn agricultural sciences. Let's roll on. Collateral, grant, loan. What is a collateral? What is a grant? What is a loan? So collateral is something that serves as a security when taking a loan. It serves as a security when taking up a loan. So this is a guarantee that a loan will be repaid to the lender. For example, land, okay? You can provide land as a collateral. Then if you fail to repay the loan in full, then they can take your land, okay, and they can convert that land into cash. That's called liquidation, but I don't need to know about liquidation. So then they take your land and they convert that land into cash. Then they can use that then to get the money that you failed to provide, or that's when you failed to repay the loan in full. So they take your land and say, oh, okay, because you failed to pay our loan. So now we take your land, because this land serves as a security. So it's an assurance to them, or okay, no need to worry about that person, because who provided land as a collateral. If he or she fails to pay us, then we take that land. So it serves as a security when taking a loan. Grant is provided by the government and does not need to be paid or repaid. Grant is provided by the government or by the state and does not need to be repaid. There is no need to repay grant. For example, 350 for SASA. So you don't need to pay that one. So yeah. SASA grants, social grants, yeah. Those things you don't need to pay them back. So yeah, a loan. A loan is a sum of money borrowed for a certain period of time and should be repaid with interest. When you borrow money, when you borrow money, I get so you borrow money for a specific period of time. So they can be a range, or okay, I'm borrowing it for 5 years. So when you're going to repay that money, it should come with interest, unless you took a green loan. So a green loan is something that uh, 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 they use to fund green projects, but you don't need to know about green loans. So let's just go out of the curriculum. So we'll come back. So yeah, green loan is something that green loans is those loans that they give to those green projects. Green projects is those projects that are sustainable. They don't cause harm to the environment, or they are less harmful to the environment. So they don't cause emissions, no harmful emissions. So they, if they provide products, they provide environmental friendly products. Again, for example, projects such as the project for solar panels. If uh, you want a loan for solar panels, solar panels is not like uh, generating electricity with coals, because coals, they do what, they they because coals, they release harmful emissions to the environment. Okay, and that harmful emissions to the environment, like smoke, that smoke, so that harmful emissions, they cause global warming or climate change. So yeah, so solar panels, they are sustainable. They generate electricity by converting uh, sunlight. So they convert that sun rays of that sun into electrical energy sustainably, so without releasing any harmful gases or harmful emissions. Or maybe wind turbines. Agar, yeah, so those things are green projects, so they don't cause harm to the environment, so they can give you a green loan. Agar, and a green loan, it has less interest, maybe. Yeah, but sometimes they don't give you interest. But you don't need to learn about green loans. That was just me explaining what's currently happening. So yeah, let's get back into what we were talking about. So we were talking about collateral, grant, and a loan. So a loan is a sum of money that is borrowed for a certain period of time and should be repaid with interest. So when you're going to pay it, you're going to pay it with interest. So yeah, let's move on. Problems associated with capital as a production factor. A, we have depreciation. B, we have overcapitalization. C, we have high interest rate. D, we have high risk factor. E, we have scarcity of capital. So these are the problems associated with capital as a production factor. A, depreciation. B, overcapitalization. C, high interest rate. D, high risk factor. E, scarcity of capital. Then for this part, I recommend that you do a lot of past papers, because uh, that is when there will be tables, there will be financial statements. So you just need to know how to apply, how to calculate, like what you need to do, how they answer these questions. So I will try to provide you with questions at the end of this video, or yeah, or at the end. Then we will also do corrections. Yeah, but for this, I recommend that you do theory and you also practice. Practice. Get a lot of practice from this so that you excel. Because this part is very tricky. You need to know how to calculate, how to give reasons. So you need to know your story. Know your story. Okay? But don't worry, I got you covered. We are here to learn. This is where learners learn agri-sciences. Agri-sciences. Agricultural science. So, agricultural sciences grade 12 is here to stay. Capital or financial management systems, financial records. So it is important for farm manager or farm managers to keep financial records. Why do they want to keep these financial records? To determine the profit or loss? Because what is the purpose of running a business or a agri-business if they don't know if they are making a profit or loss? They use these financial records for budgeting so that they can budget effectively. So they use these financial records to analyze the performance of the business. How is the business currently performing? Are we underperforming or are we excelling? So we need these financial records for serious matters and for valid reasons. Income statement. Income statement is a summary of all income and expenditure for a specific period. It's a summary of all income and expenditure for a specific period of time. Formulas to consider, we have the net cash income. How to calculate the net cash income? You take the cash income, then you minus the cash expenses. Profit, how to calculate profit? You take the income, then you minus the expenditure. Farm assets, formula. The formula to consider, net worth. Net worth. To calculate the net worth, you need to take the assets, then you minus the liability. Sometimes we can take the total assets, then you minus the total liability. This is the net asset. You get the net worth of the business, the net worth. Take the assets, minus the liability, then you get the net worth. So, fixed capital. What is a fixed capital? Fixed capital is that one that cannot move. Again, for example, we have the land, we have the buildings, we have the dams. You cannot move these things. They are fixed capital. Now, in B, we have movable capital. These are those ones that can move. They can move around. Livestock, for example, machine, tractor, they can move around. They can move around or they can be moved around. Working capital, again, then we have fuel, we have seeds, we have fertilizers. Then, a definition, farm asset records. Farm asset records is a list of all monetary value or economic value items on the farm. It's a list of all economic value items on the farm. Again, is a list of all monetary value or economic value items on the farm. Assets. So I made a table nyana here. As you can see, we have assets, we have liabilities. So let's start with the assets. Assets are the things that you own that have a financial value or monetary value, or we can say economic value. So are the things that you own that have a financial value or monetary value, or you can say economic value. Financial value is okay, monetary value is okay, economic value is okay, but let's take financial value. Are the things that you own that have financial value. So this assets, example of assets, it can be a farm. A farm is an asset, is a farm. Again, a land is an asset, is an asset, is an a vehicles, assets, tractors, assets, cash, assets, buildings, assets, equipment, assets, products, assets. Liabilities. Liabilities is the money that you owe and you have an obligation to pay. Liabilities is the money that you owe and you have an obligation to pay. So, one, we have a tractor loan. B, we have, two, we have overdraft. Overdraft is a liability. A bond is a liability. A bond, overdraft, tractor loan is an example of a liability. Sure. Income. Income is the money that is generated from sales of goods or services. Income is the money that is generated from the sales of goods or services. For example, cattle sales, sheep sales, they all generate income for us.
For example, when you sell vegetables in your local community, the money you earn from selling those vegetables is called sales income, or simply put, it is an income.
Variable costs. These are the expenses that depends on the production. When the production is high, they will also be high. When the production is low, they will also be low. These are the variable costs. Meaning, if the production is high, we can pay higher costs. We can have higher costs. If the production is low, we can pay low costs. We can pay low costs. So these are the variable costs, expenses that depends on the production. Meaning they can fluctuate. So seeds, they depend on the production. For example, seeds, fuel, feed, electricity. Okay? These are variable costs. Then fixed costs. These are expenses that do not change even if the production change. These are the expenses that do not change even if the production changes. Like tax. Every year in February, businesses pay tax in South Africa. In February, that's where taxes are being collected. So you cannot avoid tax. This is a fixed cost. It doesn't change, stays the same. Tax. These are expenses that do not change even if you like, even if you don't like it. you will pay tax. So these are the expenses that do not change, even if the production changes, even if you are producing less, you will still pay tax. Even if you are producing more, you will still pay tax. Then rent doesn't change. If you are paying, let me say, you have a shop, I got that you use for to sell veggies. I get then you pay, okay, you pay 3,000 per month. So even if you didn't produce that much, you will still pay for the rent 3,000 every month. Click one. So even if you produce more, you'll still pay the rent 3,000 fixed costs. So receipts. I don't know if I'm pronouncing it correctly. Receipts is the money that comes into the business. Then payments is the money that is leaving our business. It's the money out of the business. It's leaving our business. Income is the money generated from the sale of goods or services. For example, money received from the sale of livestock. That's income. Expenditure, costs incurred when paying for goods or services. That's expenditure. Costs incurred when paying for goods or services. Okay, for example, electricity, telephone costs, these are the expenditure. Yeah, let's move on. Let's roll on.
Okay, that means expenses, also known as expenditure, are those costs involved in running our business, such as salaries, water, electricity, and telephone expenses. These costs are essential to produce our products.
Yes, Karabo.
Difference between whole farm budget and enterprise budget. Enterprise budget is a budget for one particular enterprise on the farm. Then whole farm budget, it combines all enterprises on the farm to show the net returns to the farm. So enterprise budget, we have enterprise budget and whole farm budget. So enterprise budget is a budget for one particular enterprise on the farm. So this budget considers only one enterprise on the farm. This is a budget made for only one enterprise on the farm. For example, wheat farm, a budget for wheat farm. So it considers only the budget for wheat. Okay, sharp. Whole farm budget. It combines all enterprises on the farm to show the net returns to the farm. So meaning they are mixing. They make a budget for all of the. They make a budget for all of the enterprises on the farm. For example, combining a budget for wheat with maize and the budget for livestock. So combining the budget for wheat with the budget for maize and the budget for livestock. So we are just combining, we are just mixing. Instead of separating them, we're just combining this budget for all of these things. So we are combining a budget for wheat with the budget for maize, the budget for livestock. Then for that, if it is like this, then it's called a whole farm budget, because we are mixing these things to have what? Because we are combining, so we are making it to be a whole. That's where whole farm budget. So it makes them whole, like we're combining them to make it one big giant budget one big giant budget. I get. So we know this one big giant budget called the whole farm budget is a mixture of the budget for maize, the budget for wheat, and the budget for livestock. I get captured sharp. So we have enterprise budget and the whole farm budget. So let's look at the main components of a cash flow statement. So number A, we have the opening balance, I get. Then B, we have the income. C, we have the expenditure. D, we have the profit or loss. And then the E, we have closing balance. So these are the main components of the cash flow statement. So it's about, okay, we have the opening balance, we have the income, we have the expenditure, we have the profit or loss, then the closing balance.
Thando wants to explain the main components of a cash flow statement for Karabo.
On the components of a cash flow statement, we have income. Income is the money that an individual or a business receives in exchange of the sale of goods, or exchange of for providing a good or service. Expenditure is a payment made for goods or services. For example, salaries or wages, water and electricity. Profit or loss is the difference between income and expenditure. That's when we minus expenses from the income. Then the amount we get should be a profit or a loss. Opening balance is the amount of money in the bank account when it is opened, or the amount of money that is available in the bank when starting a month or a year. Closing balance is the amount remaining in an account at the end of the accounting period or at the end of the financial year.
George is explaining the cash flow budget statement.
Is a projection of expected cash that will flow into and out of the business for a specific period of time. This means it is the projection of income and expenditure for a specific period of time. So, with cash flow budget statement, the farm manager can identify the months where there will be less expenses or the months where there will be more money flowing into our business. You say, aha, okay, from January, February, March, there will be less expenses. Okay, aha, from November to December, there will be more money flowing to the business. So you can say, oh, okay, this cash flow budget statement, that's what helps us with the projection of income and expenditure for a specific period of time. So it tells us the months where there will be this expected cash flows into and out of our business. Cash flow. So don't confuse cash flow with cash flow budget statement. So cash flow is the movement of money into the business and out of the business over a certain period of time. Balance sheet is a financial document that shows the total assets and the total liabilities of a specific business. The formula for balance sheet: net worth. Net worth is equal to assets minus liabilities. Then you get the net worth of your business.